Hello and welcome to the Digital Asset Report. I'm Jane King at the New York Stock Exchange. With me today, Vincent Molinari, CEO of Liquid M Capital. Welcome back.
Hey Jane, thanks. Great to be here.
So interesting to talk about. Today we're going to talk about SAFTs. So with this whole digital currency, blockchain, there are new terms we have to get used to, and SAFT is a new one, so explain that.
Yeah, and I think it'd be really helpful to take a step back and I guess go through the evolution of how the SAFT arrived.
Okay. And
it's really born out of something called the SAFE, which is the Simple Agreement for Future Equity Delivery.
Okay.
And that's probably about 2013. That was developed by Y Combinator. And the genesis was really trying to find a fast and easy way for investors to invest in kind of early stage companies without having to do a lot of documentation, a lot of negotiation, and bear the expensive legal costs. And that was a great concept to the extent that you believe that it actually worked for companies that were raising $1 million, $2 million, maybe $3 million, more seed round capital. And what it really said is that at some point in the future, you would get equity for your investment. And there were a number of triggers that were involved. For example, the next round of financing. So when you had an institutional level financing or a venture capital backed financing, you would get maybe a 20% discount as a safe holder.
I see.
And that's how you would achieve your equity.
Okay.
But there were lots of pitfalls because if the company went bankrupt in the interim, you didn't have any standing in the capital structure, you weren't a debt instrument that was protected. Right. And frankly, if there were never a future financing to trigger that event, you kind of just sat and never land.
Okay, so you basically got in. Well, that was one of my first questions was, if I'm an investor in this, there's a chance I may never get the tokens in the company, right?
Well, that's the perfect pivot point. So to address some of the issues around whether it's a utility token or a security token, some of our previous conversations, the law firm Cooley came up with a structure called the SAFT, right, which is the Simple Agreement for Future Token Delivery versus Equity. So if we harken back to some SEC comments around the SAFE, they said this instrument is not simple nor is it safe because it's very issuer oriented and there's not a lot of rights incumbent to
Not a lot of protections for the investor.
So I think when you start with a premise of an instrument that's not the best in the first instance and you try to recreate it to a marketplace that's a little clumsy and evolving, you come out with a poor outcome. So yes, there's a very strong likelihood if things don't go right, you may never get those delivered as a safe in your future token delivery.
Is this a contract? Is it a token? What is it?
Well, it's a great question. You know, it is not a token until it's created.
Okay.
Where I think it gets particularly difficult to deal with when you put some things out as Cooley has done, and they're trying to create a structure for this, and I think it needs more work.
Okay.
Or frankly to be scrapped and start again. Because if you then take a SAFT and you start in the beginning to talk about rate of returns and speculation and profits and flipping, my goodness, you're square down the front runway of looking at a security. Well, if you're converting then at some point in the future to a token, and that token, as people talk about being a utility token, it's beyond me to understand how you go from a security instrument on the front end and come out the back end with a utility.
Futures contract, kind of.
Well,
yeah.
So what is this thing? So I think we end up in a situation where there are the lack of investor protections and uncertainty, and it's really compounded by the fact, if we go back to the beginning of our conversation, the SAFE was born out of a couple of $1 million kind of concept. Well, when you overfund perhaps SAFs to $25, $50, $100 million, there may never be another round of financing. Therefore, what is the trigger event?
I see.
So very complicated, and I think clumsy in the marketplace, both regulatory-wise and certainly investor understanding.
So if I have a company and I am doing an ICO, at what point would I consider a SAFT? Like, what kind of companies explore this type of financial contract?
Well, I'd say from our position as Liquid M Capital and a regulated entity, we're not embracing SAFs. We don't think it's a structure that's going to...
Very early stage, I guess.
Well, certainly early stage companies. And I think it becomes a question, what is the outcome? Because if you then have this utility on the backside, well, if it's native to the app, as we talked about in the past, it certainly could be a utility. But if you're talking to participants about getting liquidity and selling that, well, then you're really not selling a utility token. Are you selling a security token or, indeed, as we talked about, a commodity token with CFTC? So as it originated for earlier companies, we just think it's not the best structure
Okay,
today.
better ways to finance those early stages than a SAFT.
Well, we'll go straight down the middle again. I think where we end up with these complications is people trying to be perhaps overly creative to, I don't want to say avoid, but not embrace regulation and securities practice the way they should be.
That's gotten us in trouble in the past.
Well, I think we're going to see more and more of it. You know,
okay.
just last week, Director of Corporate Finance, William Hinman, giving his speech, very clear about the belief on ICOs, and now enforcement. The day of getting the free pass seems to be over, and more enforcement actions seem to be coming. So to us, this is a securities business. Let's go back to talking about Reg A+, Reg D, Reg S, and embracing those existing securities frameworks and kind of put this stuff aside until somebody has a better mousetrap.
So you mentioned the Cardoza Law School report on blockchain. How does that fit into the whole SAFT discussion?
Well, I think, you know, it was great to see a law school commissioning the I believe it's called the Blockchain Research Project. And their first report is on the SAFT. And I would say, fair to say, they came out fairly critical of the SAFT for some of the same reasons that we just discussed. That, and you should take a look at that report. Aaron Wright, I think, who is the lead at Cardoza on the project, very robust, full of great information, talking about some of the shortcomings and the fact that this is indeed talking about rates return, speculation, flipping, and that's a security, and how they come out to try to come with a conclusion around a utility token out of that outcome. Nice to see that a law firm that's organized some great minds around blockchain and other attorneys coming out with the same outcome.
So where do SAFs go from here? I mean, it seems like there's a lot of skepticism in the industry about them. Maybe they just kind of go away, or will they be refined and tweaked?
Well, I think the good thing that Cooley had come out when they put out their original white paper, you know, look to engage with the community, look to engage in conversation, and have comments. And I think that's where the Cardoza report was born, out of that request for comment, almost. So I'm not sure if it goes away, but certainly in our opinion needs lots of improvement.
Okay. All right. Thank you, Vince, for sharing this. Always good advice for people that are kind of exploring this industry. So appreciate it. Yes. Thank you very much, Vince Molinari, CEO of Liquid M Capital. And I'm Jane King at the New York Stock Exchange. You've been watching the Digital Asset Report. Have a great day.